You've got this.
All right. Hello, everybody. Good day, good morning, or good afternoon, depending where you're at. I hope those of you on the East Coast have managed to dig out and are taking a break from shoveling while you listen to this webinar. So, welcome. I can relate. I'm from Minnesota. So, um, today's seminar will be on non-discrimination testing and other regulatory updates. So in today's agenda, we're going to talk high level about non-discrimination testing. We will go over the distinctions between highly compensated individuals versus key employees. We'll talk about the various types of testing required for health and welfare benefits and any other coverage requirements that you should pay attention to. And then the balance of the meeting, we're really going to provide some compliance updates for you. This is a busy time of year. You've all just, many of you have implemented your January 1 plans. And then, of course, there's IRS calendar items that are due this quarter. So we'll go over the compliance calendar high level. And then I'll give you some other important updates that you can be thinking about as you design your benefits. So, moving on to non-discrimination testing, let's first talk about Section 125. So, Section 125 is, and most of the numbers and sections that we'll be discussing today come out of the Internal Revenue Code. So, these are IRS obligations for the most part that tie into your employee benefit plans. Section 125 plan is a very broad IRS framework that actually allows you as employers to deduct expenses for some of these benefits with respect to employer contributions and participating in premium payments. And then it also allows employees to take those employer contributions or premium payments and not take them as income. So most everything will start with a plan document. So you can have a Section 125 plan document that will memorialize the elections and the rules in order to get that tax favored treatment. Sometimes you'll hear the term premium only plans. So that is strictly for premium payments that are on a tax favored basis. So all premium only plans are Section 125 plans, but not all Section 125 plans are premium only plans because there are other coverages such as self-funded. So, high level, let's just go over some of this. So, employers that are offering health and welfare benefits, they must satisfy non-discrimination rules in order to preserve or maintain that tax treatment. And so that's the importance of doing the non-discrimination testing. And we'll talk about how frequently you should do it and when are ideal times to do it. But it's really about maintaining or preserving that tax favored status for both the corporation and the individuals. So again, we talked high level about Section 125. So again, when you think about the documentation, most everybody has a big wrap document that will talk about the various benefits that have this tax favored treatment. Sometimes they wrap around all of the various component benefits, but for every single benefit that is provided in your health and welfare plans that are subject to 125, you also need to have that separate documentation. So if you have a fully insured medical plan, it would be the master policy. If you had a self-funded medical plan, as an example, It would be the summary plan description and the plan documentation that needs to support it. They should also include the eligibility rules and in order to, again, support the overall preservation and maintenance of that tax favored status. I'm just highlighting for you here a list of the various code sections. Some people like to talk in code, others do not. I'll try to do both today. So as you can see, if you move down into the component benefits itself, you have section 105H rules when you're testing the benefits themselves, and that applies to self-insured medical, health reimbursement accounts, and health flexible spending accounts. So you will, in those cases, you would test the section 125 for the favorable tax treatment of those premiums or contributions. And then you will also test the effects of your plan designs using the section 105H rules. Okay, so then moving on, you have section 129 that will cover the dependent care assistant programs. You have section 79. Many of you are familiar with that, where group term life in excess of 50,000, it needs to be imputed income on the W-2s, but you also need to do a section 79 non-discrimination testing as well. Then there's section 137, adoption assistance. And then there is this little ACA code section, section 2716, where they were going to also require non-discrimination testing of insured medical, but that enforcement was deferred. And we'll remind you about that because it's a little nuance or wrinkle, but it's a good one. And then testing typically is performed each plan year at a minimum annually, but I would suggest maybe doing it in March when the other IRS reporting has calmed down, and so that you can project whether or not you are still going to maintain that favorable tax treatment. If not, then you will have time to make some adjustments to your plans potentially. And then at the end of the year, so that you can anticipate and let anybody know of the highly compensated individuals or the key employees, whether or not they will get taxed due to the discrimination aspects. And then again, failure to comply, it will actually cause the tax income to be reported by the highly compensated or the key employees. It does not penalize the non-highly compensated individuals. All right, so moving on, there are different definitions, and so you really need to look at your code sections because there's slight nuances as to who's a highly compensated individual versus a key employee. We in compliance have been asked before, give me all of the attributes to do one report for all non-discrimination testing. Well, that's almost an impossibility. Probably somebody's done it, but because there are the different definitions of highly compensated individuals, there's actually two different definitions depending on what section it applies to. There's key employee definitions. All of those need to be taken into consideration. The other thing, too, that I'll mention high level right here is that if you're an applicable large employer and you've offered different benefits to different member entities, when you do non-discrimination testing, it oftentimes has to get consolidated so that you're looking at the entirety of the organization as an applicable large employer to identify who's highly compensated individuals and key employees. So sometimes each of those member entities may have a different payroll source. So it does take a little bit of pre-planning and a little bit of organization to pull that all together. So just some things to be thinking about, and I'll try to throw out some of those tips along the way. So when we talk about Section 125, or we talk about Section 120, which is group legal service plans, as an example, the definition that you use for highly compensated individuals are all of the below. So if you are greater than 5% owner and you're receiving benefits, if you're an officer and you're receiving benefits, if you are highly compensated, and you need to go into the definition under Section 414 to identify what is highly compensated. If you, and this is something that people often overlook and is again very difficult because the payroll system just doesn't say necessarily that the spouse or the dependent who might have enrolled separately from the, say, an owner, each of them also are considered highly compensated individuals, and they oftentimes get overlooked. They may have different last names, and so it's not always obvious. So make sure you pay attention to that. And then, note that Section 125 elections do apply also to fully insured medical for the premium component. The benefits have been deferred. Now, there's another definition for self-insured medical plans, which include HRAs, and the definition of highly compensated individuals for that, for those component benefits, are one of the five highest paid officers, a greater than 10% shareholder or owner, or if you're among the highest paid of all employees, and there are some exclusions that you don't have to consider. So you'll have to look at the definitions, but know that there could be some. And then note in this instance, the spouse or dependents, that definition does not apply here. And we've already talked about the fully insured medical. So the reason why they don't, that component benefit, again, because under the ACA, Section 2716, they had wanted to have discrimination testing performed on fully insured, but they deferred it indefinitely. And so there is no enforcement. So people are not testing that component benefit. They are testing the premium. Otherwise, it would have probably met this definition. And then under a key employee definition, you look to Section 416I, and it's an officer above the indexed compensation threshold, which is indexed, and that usually means that it is changed year over year and inflation adjusted likely, and greater than 5% owner or greater than 1% owner earning greater than $150,000. All right. So moving on, let's talk again about the Section 125 cafeteria plan, which tests need to be performed for Section 125 to maintain that tax favored status. You do have to look at an eligibility test. Who is it that participates? And that's how most of the eligibilities are, who actually has it available to them and or accessing, and who's actually participating and enrolling. So eligibility tests is important for Section 125. Contributions and benefits testing are important tests. Are the terms richer for highly compensated individuals or highly paid individuals, including looking at the amount of contributions or benefits? And then lastly, on the key employee concentration testing, no more than 20% of the plan's total benefits can go to key employees. So you will have to enlist for benefits. You'll have to understand how, in some cases, the amount of claims that are claim benefits that were ultimately paid during the year as well. And again, the penalties are that those taxes or those benefits become taxable to the highly compensated individual or the key employee. And then under like section 105, the reimbursements under the plan become taxable. So that's an important one to pay attention to. So, tips, what can you do to stay so that you can maintain or preserve that tax advantage status? We talked about doing that calendar year testing. Run it mid-year and year-end as well, so you can anticipate whether or not you need to include in the W-2s, as we mentioned before. Make sure you understand your testing populations. Make sure you understand, are you an applicable large employer with multiple members performing the testing on their own, but that certain individuals need to be aggregated? Make sure you understand that and you know and can identify who are the officers. Sometimes officers change frequently, so keeping up on that. Ownership changes in, entity acquisitions or selling off entities. That's all important. And knowing if there are any excludable employees, such as some COBRA participants. And we'll talk a little bit later about when the COBRA participants have to be included. So really monitor and watch your benefit design. Don't create an executive HRA or an enhanced self-funded tier without testing to make sure that it does not have this unfavorable impact. And make sure you retain your documentation. Auditors are going to want this. And it's not just the DOL who might come in and want to do some auditing or the EBSA, which we're going to talk about at the end of this call. But you also, if you're just up for your regular federal IRS tax audit, they will be asking for this information. So documentation is core important. I didn't mention, but you do need to have your wrap documentation signed before the effective date of those plan years. And if you find yourself in a situation where you didn't get that done, please seek legal advice and counsel to help you navigate that. And then educate up, educate down. In my tagline, this is preaching, but I've been involved in organizations where the executives get together and we look at the design. I've been in companies where I ran operations, so I had some of the lowest paid and some of the higher paid individuals. Be their advocate. You will, this is also a recruitment retention tool to offer those benefits so that you get and keep the best and the brightest. So make sure that you're having those discussions. Have it with the executive team so they understand that depending on that design, that they could end up having taxable income, and just give them a heads up before you end up in that scenario, even if you don't intend to be in that scenario. And then educate down. Really try to convince all of the employees about the benefits. If you're designing these plans for the benefit of your employees, don't be afraid to share those benefits and why it's really important for each of those associates to take advantage of them. So moving on, I won't go into a lot of detail about each one, but I've built these tables here for you to have a high-level understanding of what tests must be performed. So again, we've talked a lot about the Section 125 plan. It includes pre-tax premiums. That would be dental and vision as well. I talk a lot about medical, but don't forget those premiums as well. And health FSA, and HSA contributions, DCAP, and adoption assistance. Again, those are all examples of benefits that will be, if they are taken on a pre-tax basis, are subject to 125. And then there are the 3 tests that you will need to satisfy: the eligibility test, contributions and benefits test, and the key employee concentration. And then who is protected? In this case, it's the non-highly compensated employees and or individuals. The code usually uses HCI, but oftentimes you will see even in Xywave's documentation HCE for the meaning the employee. And then I've also highlighted the consequences. Section 105, it includes self-insured medical. Don't forget about your HRAs and your health FSAs. So if you have employees that work in San Francisco and and you as a business are required to be licensed to do business in the state of California, and you have a fair amount, and so you've established your own HRA to satisfy the provisions of the Healthcare Security Act for San Francisco, then you need to make sure that you're doing the testing and that benefit is correct. You will also, as a reminder, need to do 5500 reporting. Just an added benefit. Section 129, again, that covers dependent care assistance. There are 4 different tests that must be met here. And so it's the eligibility, again, the contributions and benefits test. In the case of the average benefits test for dependent care assistance, the average benefits, so it's like for everybody that use those benefits, it must be a non-highly compensated individual must be greater than or equal to 55% of the average of the highly compensated individuals. So some of these tests get very complex, which is why it's really important for you, or where you have complex benefits and structures, that you either engage your payroll vendors or another vendor to perform this testing for you. And then Section 79, again, we think of that as the excess of 50,000 that you report on the W-2, as I mentioned, but you also need to test for the discrimination. So both an eligibility test in the case of group term life as well as the benefits test. And then adoption assistance, again, it's the availability of those benefits cannot favor highly compensated employees. So if you have an executive that is choosing to adopt this next year and they come to you and say, hey, I want to, can we establish this so I can get that benefit? Unless you have some others, that may or may not be the right thing to do. And again, we mentioned this already, but there was under Section 2716 of the ACA that there is no required component testing of insured medical. You've heard that a few times. So here's again the laundry list of what should be covered under Section 125. So I want to warn you a little bit. So again, we talked about the overall definition of Section 125 and POP only. So POP only is only for insured, but Section 125 can include ERISA coverages, right? So if you have an ERISA coverage and you have these elections that you want pre-tax deduction or pre-tax contributions, then you will be subject to the 125 and you should include those. And once you have them there, then you know that when you do your 5500 filing, if you meet those requirements for doing either the short or the long form, that those benefits need to be reported on Section 55. If you have voluntary benefits that are not subject to ERISA and that are not taken pre-tax, then you probably don't want to include them in your Section 125. I've seen that happen, and I've seen where, oh, it's just easier to put it all in one big document. But unfortunately, when you do that, you will have to also disclose everything on the 5500 filing, everything that's in your Section 125. And you may or may not want to do that and have that extra work. So my tip is, if it's not subject to 125, if it's not needed, don't put your voluntary benefits that are taken post-tax and not subject to ERISA in your Section 125 document. All right. Let's just high level touch on what we haven't covered. So we did talk about the first couple bullets that again, and I use the example of testing the overall Section 125 and then each of its component benefits. So number 2 is just emphasizing that. But COBRA. So some of you and because I do get this question oftentimes in at Relations EB compliance about whether or not when you are terminating an employee, many employers feel a little bit of guilt and they want to subsidize COBRA premiums for a few months. There are a variety of reasons that I can come up with that is not the topic of today's conversation as to why that's probably not the best practice. You are better off doing something else, giving them a larger severance or doing something else. This is one area too where you do the subsidies. A normal COBRA participant would not need, those would be excluded from testing. But if you are providing a subsidy, then you do need to include those in your testing. So just a practice tip to watch out for that as well. And again, you can make your decision one way or the other, whether you want to subsidize that or not, but just know that there is that extra testing that or that they need to be included in the population. And again, I'm suggesting at a minimum of testing on an annual basis. But again, if you do it the 2 different times, you will likely have no surprises, which has nothing to do with the CAA Act. And then again, maintain your documentation for years in case you are audited. And then note that there are times that you do need to make some corrections or you've done something incorrectly. So just watch for that as well. And then here I've just highlighted for you kind of an order of, a practical checklist for your non-discrimination testing. Again, really identifying those test populations for each, the Section 125 and the component benefits. Sometimes unions are also excluded. Non-resident aliens, those get excluded from testing. And the rationale behind the union is that they're collectively bargained. And so it is what you end up with for your benefits. So, through that process, ideally they won't be non-discriminatory, they won't be discriminatory, but that is not, you will exclude those from your populations. And then again, as we talked about, really understanding the definitions of the highly compensated employees and individuals and key employees, depending on which type of component benefit you're testing. Run your tests for the various, document your results, and if need be, by the end of the year, in time for the January W-2 filing, make sure that you make any and do any course corrections. And then other just practical considerations is your carriers are not responsible for performing those tests. You, as the group health plan and plan sponsor, you are the one responsible for that testing. It doesn't mean the carriers won't support you and give you some of the information required for testing, but they are not responsible. And likewise for, the self-funded coverages, again, TPAs, FSA administrators, they are not responsible. Many of them will support that testing as much as they can, providing reports to you, providing census to you, and those tools. But again, the obligation really does fall under the plan. All right. Well, that's what we have on the non-discrimination testing. Now, in the time remaining, which we are doing pretty good on time, is I am going to update you on various legislative, judicial, and executive updates. So, one of the first things that I thought I would do, because this is a busy quarter, is to just highlight the compliance calendar for the next few months. And so, for any of you that are doing paper filings for the employer shared responsibility, pay or play, I'm not going to throw out another section of the IRS code, but if you do handle that reporting to both the IRS and your employees in paper, because you're pretty small, just note that that deadline is February 28th. As of March 1st, the employer-sponsored group health plans, they must submit their PHI, protected health information. Sorry, I didn't spell that out for you. But they need to annually do their PHI breach reporting to the Office of Civil Rights. It's due within 60 days of the end of the plan year. Now, note if you have a very large breach that is 500 plus or more individuals, you do need to file a single incident report within 60 days of the breach. And so keep that in mind. And then some of you may also be aware that if your breach is related to a ransomware, that also there's some special rules on filing that right away. So just something we don't always remind you of, but it is an obligation of, again, those employer plans that are responsible for HIPAA. Some of you that are just fully insured medical and the only thing you do is enrollment and you never see any other PHI information, then you won't necessarily have to perform some of those functions. Then March 2nd, this is where we're getting into and the March 31st deadlines of furnishing the electronic, the individual returns under the employer shared responsibility to your employees. Of course, some states you always have to provide them to the individuals no matter what. But there have been some relaxed rules generally for the federal requirement that you don't necessarily have to give them to all individuals electronically. However, as a practicality, most of the groups that I've been dealing with on this issue have said it's a lot easier to just continue giving those individual, even if it's an electronic format, to all individuals and not wait for it to be on request. And then March 31st, that's where you do the final transmission to the IRS if you are doing filing electronically and not in the paper format. And then just a high level deadline, April 15th. This is where both you as an employer or an individual can correct your HSA contributions. Maybe you accidentally overpaid or went over the limit, as long as that gets adjusted by April 15th. So keep those deadlines in mind. All right. So recently, and I believe we sent out a XyWaves bulletin on this as well, the Department of Labor each year will provide a highlight of what it is that will be their priorities for auditing by the Employee Benefit Security Administration, who actually performs the audits. What are they going to be focused on for the year 2026? Now, in the budget, there is a lot of money set aside to do auditing. So, just know that that's out there, and it's highly likely that there will be quite a bit of audits. And so I'm just going to go over some of the priorities and then follow up with what are some mitigation strategies that you can employ to try to mitigate some of that risk. So, of course, we all know about the very large Change Healthcare breach. We also know of, some of the consumer-directed accounts, such as Health Equity, some of the biggies that have had breaches. So, given I mean, many, many breaches by not it's a lot of times it's vendors, right? And so be thinking about your vendors. But it's really important that you are doing that oversight. As a plan, if you are subject to HIPAA as a group plan sponsor, and it's not just incidental enrollment, but you are responsible and you have your full-blown HIPAA procedures, you do need to do and perform oversight on those cybersecurity risks. And so we have an audit tool that we use to help highlight who are your vendors and at a minimum go out and try to collect some information, which I'll talk about in a little bit. The administration has also said they are going to focus on mental health and substance abuse disorder. They are going to also look at the No Surprises Act, and they're going to look at different aspects. There's a lot of different components. It was a 1,158-page bill. It covered, a different definition of emergency services. It talks about cost sharing, and grandfathered plans and non-grandfathered plans are subject to the No Surprises Act. And then the next two are really about the retirement plan benefits. So just know they're there. The protection of the delayed or abandoned benefit distributions, those are really safeguards for retirement plan participants and beneficiaries due to delays, denials, or errors in receiving benefits. And then, your fiduciary monitoring of your retirement asset, that oversight is really core critical. And then lastly, they will also look for any criminal abuse of contributory benefit plans. So where the employee contributions themselves have been misused. Now, let's talk about some mitigation strategies. Again, with respect to the HIPAA and vendor oversight that is required, I know you'll all have your business associates agreements in place with your vendors, but on an annual basis, it is really important that you obtain the certificate of insurance coverage, the COI or Accord form, on an annual basis from those vendors so that you know that they have the required insurance coverage, including cybersecurity, and knowing what those limits are. Are they 5 million? Are they 10 million? Do they get an excess layer of coverage? Those are very important. And then you should also, on an annual basis, ask them if they're performing a statement of controls audit. And I'm not talking about a business process. So many TPAs have a claims business process statement of controls audit. I'm also talking about a security audit. That is very important. So get that at a minimum, those things in place. And you could even ask them to fill out a questionnaire and know who their privacy and security officers are, as an example. Moving on to the next one, mental health parity. It is really critical that you do those reports. There have been many reminders. Anybody who's been audited, and I have seen checklists for some of the larger employers coming from the DOL, where I participated as a TPA and had to provide documentation along with the PPO documentation to some very large organizations. So they are doing this audit. No one's passing 100%. At a minimum, you could do a self-analysis, but in the last round of modified requirements under mental health parity, they really expect you to document evidentiary standards and factors. And so, for example, if you hire a TPA, who happens to have a PPO and they also have medical management, you need to understand how that if the chief medical officer, are they discriminatory? If they're a network, do they accept all provider types? So it really, if you have a TPA or an insurance carrier, the best place is to go to them and say, hey, can you perform this testing on my behalf, or do you have a preferred actuary? That's the best way to do it. And then once you get the initial report done, you just do a refresher for your changes in benefit and looking at your actual outcomes, your paid claims data to see, are you really, is there more out of network benefits provided? Is it richer or on par in the actual paid claims data? Does it support that? So again, an actuarial opinion is the best. You could do a self-analysis if you need to. Once you have that actuarial opinion, I recommend a refresher. Moving on to the next one is again the No Surprises Act. There's various aspects that you really need. So think back to last December. Who performed that testing or who did the filing for the gag clause? Did you actually have the carrier do it? Did you have the TPA do it? Did the TPA do both the medical and your PBM? Really know who did the filing for both your networks, all levels of networks, domestic. Maybe you have a friends and family tier. Maybe you have a rep network tier. Each network needs that attestation, even clinically integrated networks that are quite common across the nation. What, even if you do delegate that responsibility and somebody is performing that, best practices is that you have a copy of each of the attestations from each network and each PBM. Some of the PBMs will post a general one on their websites. So at a minimum, go out and find that. But please retain all of those. The latest guidance also said have a copy of a contract, but I don't think that's easy to do. So at a minimum, have your attestations. And then really understand under the No Surprises Act so the No Surprises Act, even if you're a self-funded plan, it's the one benefit that if a member appeals under a No Surprises Act, they get a right to external review. And there are certain states that have all payer databases that have already designated. There's less than five that actually have designated certain external reviews. Are those in your notices? Ask your TPA, ask your fully insured medical carrier, how do those benefits under the NSA get reviewed? And then again, like anything, the next one is have your documentation available. That's core critical. And then again, if you're a part of a multiple employer welfare arrangement, please work with them to understand where the risks may fall. All right, so this is a standard slide that I put in all of the external webinars. And you can see at the top, I've got the URL for where you can go on a daily, weekly, monthly basis and just look, and it will give you a list of what are the recent activities. I'm not going to read all of these to you, but I'll just mention a couple that I found, oh, I didn't really know that, is that, so under the IRS guidelines, and I think everybody knows you can now submit your IRS return, is that IRS is going to phase out paper refund checks, probably due to fraud, so that taxpayers are encouraged to use direct deposit. And then because we did have earlier this year a webinar on the One Big Beautiful Bill Act, I think that was in August, there is a new deduction schedule that you will have to submit. It's Schedule 1A to for that for those benefits. And then again, the Trump accounts, we will be talking about that more deeply a little bit later. Under the DOL, again, the very last one. So the DOL did issue a proposed regulation on PBM manager fee disclosure. And so there will be more guidance coming out on that. Of course, the really big one is that the Consolidated Appropriations Act of 2026, which we're going to go over, has a lot about PBM disclosures. So just note that's out there. Then moving on, I also have, again, I'm just reiterating the same URLs, but I did want to point out that on December 23rd, for those of you that are subject to transparency and coverage rules, grandfathered plans, a lot of the provisions do not apply to you. So, but for the rest of you, on December 23rd, some proposed rules came out. They fundamentally want to wholesale change the machine readable process, which was very highly complex. And again, group plan sponsors are the ones responsible and are the ones that are penalized, even where either a PPO or a TPA or a carrier or health plan do the work on your behalf. So I think the legislation has recognized it got very complicated. So when the initial legislation came out, there were supposed to be 3 machine readable files posted for each plan. So some of you might have a PPO plan. You might have a high deductible health plan. You might have a Kaiser HMO. If you have 3 plans, then for each plan, you would be required, or your TPA is likely, or your carrier health plan are posting on your behalf in a publicly facing location a URL so that anybody can get to your 3 files that you're supposed to be posting. One was the in-network discount files, which is every discount for every, I call them doorknob and belly buttons, but for each of your providers, they're discounts. And then there was a second file, which was the out-of-network discounts. And that file was created again for each of those 3 plans in my example. You would go back 6 months and it would be a 90 days. So if you were January 1 posting your machine readable files, you'd go back and July 1 through September 30th, data would be used to say what you paid for out of network services. I think they recognize that splitting a group or plan up into that many component parts is very difficult. It is also, they're supposed to be posted and updated on a monthly basis. So they are proposing a good thing for all of you is to move it from the plan level of each of those individual plans to an employer level. And they're also looking at doing the out of network at more of an aggregation level, perhaps at a TPA level or other levels. So that is something we will be watching very closely to see how that works. Today in our audits, we do ask about where those files are located or those URLs. It is important that you know and that they are publicly somewhere on behalf of your plan, because if they're not, you're the one that get fined. Now, many of you have within your agreements with your TPAs and carriers and health plans that you expect them to comply with the law. And so some of you will have a lot of detail, and So when this change comes into play, you might not have to redo those agreements, but just have that on your radar and we'll try to keep you posted on this. I feel like it's a biggie and I feel like they're moving in a favorable direction for you as employers. And then I like to highlight what's going on with executive orders. Some of you may have seen last night's State of the Union, probably not the detail necessarily, but so you know what's sort of on that radar. Legislative activity, again, the ACA premium tax credits, those did not get extended. But then the last one in the middle page is really important. Most people have interpreted that when the broker consultant disclosures came out, that the TPAs would disclose their compensation as well. It was a little bit vague. So in the February 9th provisions, it clearly says that both PBMs and TPAs are responsible for disclosing that compensation. And therefore, when you do your filings, you should be recording all of that compensation. And I know there'll be a lot more to come and guidance on especially the PBM components. All right. Then let's talk about the Consolidated Appropriations Act of 2026 in the time remaining. So, you may know Relation Insurance as a company is a member of the Council of Insurance Agents and Brokers, sometimes referred to as CIAB. We have various constituents across the organization that participate at different levels, whether you're operations or CEOs, and participate in various working groups. I, along with our legal counsel, we do participate in the legal working group. And so I had the privilege the first week of February to actually, on February 3rd, when this was passed, voted on, passed, and signed by the president, the Consolidated Appropriations Act of 2026. I was sitting in the Senate building when all that occurred. And it is quite a sea change when it comes to PBMs. We've already talked about the PBM and the TPA disclosures, or including the TPA disclosures. The bill also, or the act also covers drug level reporting, plan level summaries for all group plans. It does not matter the size. There will be extensive data reporting for large employers, and the definition of that will be the average of 100 employees during the calendar or prior year. And it will include the laundry list that you see here of items that will need to be reported on. There is, of course, and probably one of the most favorable one is the 100% mandatory rebate pass-through. There are TPAs that are already doing that, but everything from the PBM on down, they should be passing that through to you. That's a big win, and is highlighted there. That will go into effect. Some of these provisions will start going into effect beginning on or after August 3rd. It's a very large act. A PBM contract with a group health plan will not be considered reasonable under ERISA unless the PBM does all of the things that are listed here. Again, I am sure there will be that we will be publishing or Xywaves will be publishing more on each of these areas, and so be looking for that. So what did not make it into the bill? Well, it did not extend the premium tax credits, as I think we all know. It did not include policies that President Trump wanted to expand tax preferred accounts. It was under his great healthcare plan. And then it did not codify the most favored nation deals to lower prescription drug costs. But if you do go out on the Trump website, you will see information on the Trump RX program. Some of it will benefit a commercial population, but it's really more about if the individuals themselves go out there. Um, and I think I have a slide on that as well. All right, so we recently sent out some HIPAA updates. So, so it has been quite some time that we all knew that by February 16th of 2026, all of you group health plans that are subject to HIPAA and have your own notice of privacy practices required changes to address Part 2 records. So, first off, just to put the definition out there, Part 2 is a law that protects the confidentiality of patient records for individuals that are receiving services from a federally assisted treatment program for substance abuse disorder. This includes federally assisted programs that provide education, prevention, training, treatment, rehabilitation, or research. So, that due to the sensitivity of this information and records surrounding substance abuse disorder, the notices needed to be clarified to let participants know how that information would be kept confidential. Unfortunately, even though the Department of Health and Human Services has many different versions of model HIPAA notices, some fun booklet ones, some with more cartoons, some with very detailed. They have a lot of different model notices out there. They did not publish one timely in order to meet the February 16th deadline. However, on February 13th, they finally did issue one model notice. Now, the issue is if you do certain things with the data, and that over time with your data, say you're a self-funded plan, and you use that data for certain purposes, you need to disclose that in your notice of privacy practice. So if you have been modifying the model notice for some specific areas that you do to keep the data safe or not, then you might not want to just take the model notice. You may want to incorporate and amend your existing. Otherwise, for those of you that have always just adopted the model notice, you may want to take the model notice that is now out there and available, even though not timely. As a reminder, HIPAA notices of privacy practices are required to be every 3 years published. Many of our clients just do it on an annual basis to have it at the forefront for all participants and then not keeping track of who was it that's received it before. That's just a best practice. And but there are some other things that you need to know about this modification of Part 2 program records. You may wish to, because of the sensitive nature of these records that are just for a subset of individuals that have these federally assisted treatments, you may want to reach out to your TPA or your health plan and carrier and ask them if they have an authorization form that those members that get those treatments will sign off on, saying it can be used for certain purposes. Each of those members can also withdraw at any time, but ideally on an annual basis would want to disclose. A lot of TPAs will require re-signature if a member's authorization is 12 months old. They'll usually likely go out and try to get an updated one. So there are some additional things that you should be looking for and doing in addition to just updating of the notice. And in some cases, your TPA health plans and carriers are likely masking some of that data. So even though you're a TPA and you own your data and you're accustomed to getting the data details, in these areas, it may be masked. But instead of getting incidental access to PHI that you don't want, you may just want to ask upfront. All right, Trump RX and drug pricing. I'm not going to go into a lot of detail here. This website, it changes every single day practically. You go to trumprx.gov, you can look there. Last night during the address, there was a woman there that saved a lot of money on IVF drugs and was able to access that directly. Again, the website is not necessarily designed for commercial plans, but individuals and or the governmental programs have many of the benefits that are listed here. And then high level, the Trump accounts for children. Again, the portal will be available July 6th. Individual, so I'm a new grandma as of two. I have a new grandson. I have two granddaughters as well that was born a couple weeks ago. Thankfully, his dad's a senior tax manager, so he is going to file in his individual tax return to see if he can obtain the $1,000 for because little Louis J was born in 2025. So you can remind your employees that as they have babies, and maybe you give them a little cute onesie or something when they have those births, you might want to remind them to go out and do that and file that with their individual tax return. And then, of course, some of you may want to actually also provide similar to, it's going to be a combination of an IRA slash DCAP kind of different. It's more like an IRA than it is what we're more accustomed to on the health and welfare side, but it will be more like the IRA. So I would check with your retirement planning vendors, maybe your health equities, and some of those consumer-directed accounts. Maybe they'll be participating if you're interested in these types of programs. And again, just watch for those portals to go live. There is one limitation, though, that the contribution limit is per employee. So if they have twins or triplets, it's not per child, it is per employee. So just note that when it comes to some of the limitations. There's overall limitations as well. You know, I, as a grandparent, I can contribute to little Louie's account if I want to. But again, all contributions, there are some max. So just note there's some individual rules, and there's also the true Trump RX that is offered through an employer that you need to pay attention to. All right, with that, we are at 2:01. If you have questions, please submit them to us, and we will try to get answers back to all of you. Again, have a great rest of your day. And for those of you on the East Coast, I hope you can continue to shovel out. Take care. Have a great day.